Welcome to my YouTube channel. In this video, I will discuss about how to identify a good company to invest in the stock market. Nowadays lots of people interested in invest in the stock market. It is identified as a good option to multiply your money. But lots of young people make mistakes while investing and they buy stocks blindly only following rumors. First of all, word by a master investor. Warren Buffett, who is considered as the best investor in the century, has given 2 rules of investing. The first rule is never lose your money. And the second rule is never forget rule number 1. Therefore, in order to save our hard-earned money, hope this video helped to find good companies to invest and to increase your wealth. And I hope to give more knowledge about the stock market in future videos. If you are new to this channel, click subscribe button so you will be notified once I uploaded videos like this. So let's find good companies. Before discussing about how to select a good company, let's see what is the investment strategy followed by master investors. First one is identifying a good business. Always remember, you buying a business, not a lottery. Then, the second one is buy them at good price. Which means at huge discount to intrinsic value of stock. Last or third one is wait for market to realize good value or overvalue the stock, then selling them. Okay, now you got the plan, then we can initiate it. I am going to talk about 8 criteria to find good company here. First, 7 criteria to find a good company. Last criteria is to find intrinsic value of a stock. First criteria is having history of consistently increasing sales and earnings. If earnings show consistency, then we can predict future earnings, and also this is the first indicator of good business. But be careful to check whether sales increase along with earnings, because it can be manipulated by accountants. Basically, we check this through the company's previous year financial reports. In deep, you can go through profit and loss statement or income statement to find out this. You can find financial reports through each country's official stock exchange website or on the company's website. The second criteria is having a sustainable, competitive advantage. Although the company having a good history with increasing earnings, we cannot guarantee whether they can continue that. New competitors can enter the competition and market share can be a loss. In addition, there are many reasons affecting to increase or decrease of earnings. Therefore, this competitive advantage is a valuable point to consider. Mainly this sustainable competitive advantage comes from different criteria. One is a strong brand name. For example, let's get Nike. People buy them due to its brand name. Although if any competitor comes with better shoes with a lower price, they cannot compete with Nike easily. Apple also has a similar advantage. People buy them to show loyalty and for feeling having Apple branded items. In addition to the brand, patents, market leadership, high switching cost, for example moving from Microsoft to Apple, will create a wide economical moat to defend these companies. The third criteria is having future growth drivers. If the company has no plan to enter new markets and create new products, future sales and competitive advantage will not last long. Some growth drivers are tax reductions by government, new warehouses, production lines, new applications of patents, increase in tourist arrival. We can simply find them through CEO's message or shareholder section in the financial report and through business news. You can use pestle analysis to find the growth drivers. If you have no idea about pestle analysis, it is simply checking facts that will affect the company in aspects of political, economic, social, technological, environmental and legal. If you need more info about this analysis or have any doubts, comment in the comment section so I can help you. I hope you have some idea about how to select a good company now. Although facts are there, lots of investors act blindly and buy manipulated stocks and then blame the stock market. Therefore we should have a good idea about the company. So stay tuned to get more criteria to consider. Our fourth criteria is conservative debt. Debt is a good strategy for the expansion of the business. But too much debt can lead to the bankruptcy of a company. Therefore it is important to understand money borrowed by the company is conservative and can be easily paid back within 3 to 5 years. The rule is long-term debt should be less than 3 to 4 times of current net earnings after tax. The company's long-term debt can found under long-term liabilities in the balance sheet and net earnings can found in the income statements. I will do video in the future to understand financial reports of a company without having any commerce background. For now just search in the financial report for mentioned names. The fifth criteria is the return on equity. Return on equity shows how much profit a company is generating with the money shareholders invested in it. We calculate return on equity by dividing net income by shareholders' equity which can found in balance sheet. Usually this will indicate in financial report and no need to calculate most of the time. Generally, if the return on equity is 12% we consider it a fair investment and if it is more than 15% we consider it a great investment, but they are very rare to find. Let's move to next criteria. The sixth criteria is having low capital expenditure. We call it as CAPEX also, which is simply money need to maintain current operations. For example, if the company got higher earnings but have higher operational costs then profit is low and no money left to pay back to shareholders or to expand the business. That is why, investors like Warren Buffett avoids buying companies, which required low capital expenditure. For example, he invests in Nike which doesn't own many of their factories and Coca-Cola which don't need any further researches and it never goes obsolete. We measure this by free cash flow which we get from subtracting capital expenditure from cash flow from operations. Both figures can found in the cash flow statement. If free cash flow is 5% we consider it a great company to invest. The seventh and most difficult criteria to identify is having honest management and competent at capital allocation. Before investing you should understand whether management act in the best interest of shareholders and whether management take actions to maximize long-term profits. In addition, you should research major management decisions and key developments made by them at least for the last 5 years. Okay, we have come to the end of criteria as to check when buying stocks. If the company passed the majority of the above criteria it is a good company to invest. But you should understand that master investors consider the intrinsic value of the stock when buying them after all. Thank you for watching this video. I hope you got some understanding of how to find a good company to invest. Always remember, buying stocks is not a lottery. You have to do research and buy them, and sell them at right time. As informed earlier, don't buy blindly, and control your emotions when buying. If you do not subscribe to my channel yet, please subscribe if you want videos like this and click the bell button so you will be notified once a new video uploaded. As I informed in earlier videos, the best thing to remember anything is doing it. So just download financial reports of at least 3 companies and compare above mentioned points. Oops, one point is missing, right? I intentionally remove it and add it in the next video as it takes some calculations and this video will be boring one if I added it here. Please check my video, how to find the real value of the stock for last and most important point. Thank you and stay tuned. We will back with a new video soon.